How's it going, everyone? And welcome back to Continues to Tick. Well, here we are, guys. November 2021. And if I was to look back in time, back to January, February, and maybe even March, I would have told you then that the end of the year couldn't come soon enough. And although I wouldn't have guessed it exactly right, COVID season has changed a lot since then. And a lot of society has returned to a new level of normalcy, at least for now. But may we say it, here we are, in the month that brings Thanksgiving. And given that it's officially holiday season, from my experience, this time of the year, usually, comes and goes fairly quickly. With this said, I was initially planning to share my 40K portfolio milestone this week, but the markets make no promises. Therefore, as you saw by the title of this week's video, I wanted to share some thoughts on a topic I often think about, and that is the personal challenge that is actually growing a dividend portfolio, especially in today's rather interesting markets. A time in the investment world of the ever so popular and hot investments that have been and continue to be Dogecoin, GameStop, AMC, Tesla, the NFT market, and a few others. But let me just say, seeing and hearing of the newest addition to this list, Shiba Inu, that was the last straw, man. I had to come on and just acknowledge how bizarre these hot meme stocks and cryptos have been. But lots of money has been made, or at least it's what they want you to believe. After all, everyone in the financial YouTube world has been talking about these non-stop. And here I am, talking about my beloved, slow and boring dividends. I mean, what a shame, right? How such poor returns I'm getting. And I'm just kidding. But what most seasoned investors would say to this is that with these investments come a great deal of risk and volatility. Two things I don't have to worry about as much as a dividend investor, nor two things I would want either. And the way I see it, if you're investing in these opportunities, it's all good. Make that money, I'm rooting for you. But just do be careful, as you really don't want to get caught being the last one holding the bag. And this brings me to dealing with all the investing temptations as a boring and slow dividend investor. In opposition to the hot market, dividend investing is the slow and steady, the non-flashy, but the time-tested to work, an almost sure bet, as a sure bet comes to building wealth. Just stay systematic. The foundational concept is strong with this investment strategy. A strategy to build up a portfolio in which you won't have to worry about depleting it with the 4% rule in retirement, but rather a portfolio which allows you to live off the yield and never touch the principal. That's what really attracted me to this strategy. But as you know, it's not a short-term play, so remind yourself of this often, especially as it's tempting to move money into shorter-term opportunities, such as the many we see in today's hot market. Remind yourself, dividend investing is like building a foundation to a house, maybe even a fire while camping. The careful and thoughtful time put into it, initially or up front, pays off greatly later on, with a house that very rarely will need foundational repairs, or with a fire that keeps you warm without much fighting effort. And while missing out on this step, or rushing through this step, will be felt in the future, and not in a good way. This is why, despite how exciting and also hurtful in terms of FOMO it feels to watch all this action with the hot meme stocks pass me by, and with it all these opportunities potentially to multiply my money, the truth I realize is that although this appears to be the case, on the surface at least, it's still not guaranteed. And often making money leads to greedy behavior and riskier behavior, which eventually turns into a gambling table mentality. And mindset soon switches. We get riskier, we get greedy. We tend to start expecting more quicker. We want more. Or notoriously still, this behavior may even turn into a game of financial catch-up, needing to hold on through the red tide we may have put ourselves through. It'll come back around, right? Just hold. I'm unsure if you felt this before, and it's a horrible and empty feeling, full of stress overindulgence, and obsession. All very common behaviors of markets like these. For me, opposed to this behavior, I sit quietly and systematically invest into dividends, not worrying much about anything about it, other than other stocks I'm holding paying dividends. And then the added beneficial thoughts of, oh, how much did I make in dividends this past month? Well, that one's a nice perk. But anyways, my whole point in saying this is not to completely shine a poor light on what's going on in today's markets. Its overall movement is quite strange. I could definitely see that. But to rather share information, to primarily be aware of it, and recognize that it may not align with your long-term plan of investing for a dividend portfolio. And then on top of this, to yes, be careful when watching all this short-term market movement of the meme investments. Sometimes it's better to not engage in these swings, despite the temptations they present, despite how good the opportunity may appear. Remind yourself though, although slow, although taking a lot of time, we must stay the course when it comes to dividend investing. If after all this is our goal, consistency and time are key. Don't get stuck playing in the short-term mindset with the long-term investment strategy. Especially when random everyone starts talking about Dogecoin, GameStop, or even now Shiba Inu, for example, and how much money they're going to make with their new investment. Well, that doesn't sound right, does it? And how about we take a moment to clean our palate from this meme stock talk, like by hitting the like button if you haven't yet already, and subscribing to this channel for the story, as this journey won't be stopping anytime soon. Oh yeah, and then for the palate cleanser, how about this neat picture of a clownfish chilling in some anemone? And to wrap up this week's video, we find ourselves currently at still slightly under 40K in the Jesse's cash flow portfolio, currently at $39,709.86. We continue to try to be systematic, and a big evidence of that is just taking a look at this pretty awesome chart here. But currently the portfolio's return is noted at 33.33%, which equates to a $5,543.89 total market gain. And with this, for market gain alone, we've dipped a little bit since last week, but here it is currently at $4,823.56. And our total earned dividends for the portfolio currently sits at $720.33. And if you're curious, you can always check out my portfolio. There's a link down in the description box below if you wanted to look at it a little bit more in depth. And it'll show you a lot greater detail of my portfolio. But just because I'm curious, let's take a little turn down below here. So one of our biggest gainers is tech as a sector at 64.66%. But you'd be like, Jesse, whoa, that's a pretty good return on tech. Why don't you just go all in on tech? And I mean, that's a pretty good question. And if you happen to see one of my previous videos where I kind of explained how I went into choosing my tech sector, you'd remember that Nvidia was pretty much the primary reason as to why my tech sector has been exploding. It's because Nvidia has been exploding. Nvidia has a return of 156.88% since July 20th of 2020, when I first started this portfolio. It's been absolutely exploding, as you can see here, as I had a target allocation percentage of 28%, and the actual percentage is 34.4%. And maybe you would think maybe Apple would be the next greatest performer, but it's actually not, which is interesting. It's actually Oracle at 90.32%, so one of the OGs, followed by Cisco at 44%, and then, yes, Apple. Diversification is key, I think, for that reason alone right there. And just while we're here, let's go ahead and look at the last week's performance. As I said, it wasn't very pretty. We had a 0.57% return in the red, which equates to a total portfolio loss of $228.25. And now heading into our dividend activity section, here we are for this past week's performance. We started the week off on October 26th, getting paid by Oracle, $1.01. And then October 27th came and we got paid by Cisco, $1.82. And then also on October 27th, getting paid by Comcast, $1.88. And also on this day, we had our $500 deposit, just like we always do on our weekly basis. It's part of our systematic game plan. And we had an 87-cent snowball action this last week, which I will take. I always refer back to my very first dividend payout, which was of Apple, of either 7 or 8 pennies. I will take 87 cents in a snowball any day. Any day. And then here we are on October 29th, getting paid by McCrath Rent Corps, $2.61 and 11 cents. And just before we actually do wrap up this week's video, I'm going to add a new little segment here, towards the end of my videos or somewhere in between. And that is to allow a brief and video recap of my past week polls. I have so much fun doing these and actually learn so much from you guys. So for this first one, I asked you all if you felt that working 25 years in the workforce. I asked you if working that, to you, felt like a lot. And it appears at least the majority of you do feel like 25 years in the workforce is a long time. And that gets pretty interesting, because if I actually was to remain with the state and try to work until the age of 50, building up my pension, building up my plan with this dividend portfolio, retiring right at the age of 50, for me that would be, I think, 26 years working for the state. So I would need 24 more to go. And yes, I actually do feel like it's a lot too, but is it really? If I can retire right by 50, that's still pretty early, but it doesn't negate the fact that that's a lot of your life. And the next poll question was, how long have you been at your current job? I had it broken up into 1 to 3 years, 4 to 10, 11 to 15, 15 to 20, and then 20 years plus. And it looks like the majority of us had just maybe started a new job or just recently entered the workforce, as the majority shows that they've been working at their current job for 1 to 3 years, then followed by 4 to 10 years. And then we had a little gap here, a few at 15 to 20, and then a few more at 20 years plus. If anyone has made it all the way to this ending point of the video and you made it to 20 plus years, I'm honestly really curious if you had any tips, like how is it that you made it through 20 plus years at your current job? Because for me, if I stick on my same path, working for the state, as I mentioned earlier, I'm gonna have to stay there for 20 plus years. And it seems like a far time away. But that's gonna be it for this week's video. Here we are now in November 2021. Thanksgiving's around the corner, so we gotta start prepping for that, prepping for holiday season. And before you know it, it'll be 2022. But we won't get ahead of ourselves. Let's take time as it comes. So remember, we made it through 7 days. We have a high chance of making it through another 7. And I'll see you then when the time comes, as always. And as always, take care.